A major country is collapsing. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major country is racing to prevent an unthinkable economic fallout, and you're not going to believe who this country is and what they're about to do. We're going to show you why they have no choice here, but before we get to that, I want to do a follow-up on yesterday's story because many now are saying that New York Community Bank is a one-off issue. We're making the case of why they're going to zero, and all of a sudden, as of yesterday, things got a whole lot worse. And here you can see from Bloomberg, New York Community Bank turmoil is contained as the calm prevails among regional banks as they suggest that a number of New York Community Bank's issues are idiosyncratic as an outsized rent-regulated apartment exposure recently clearing the $100 billion asset mark that ushers tougher regulatory scrutiny, and now the material weakness is internal controls. This according to Bloomberg's own intelligence analyst Herman Chan. He says no other bank squarely fits into that criteria, suggesting that this is just a problem with New York Community Bank. They took too much risk, they got out ahead of themselves, and next thing you know, it's they that have problems. The rest of the industry, well, it's okay. In fact, to the extent that even Guggenheim agrees with that. Here you see co-chair Jim Milstein describe the banking system as pretty sound on Friday. They are always going to be a couple of banks that get out over their skis, again suggesting that, hey, this is all it is a New York Community Bank issue. Well, there's two people who don't agree with that, and their names are Fitch and Moody's. As New York Community Bank is now downgraded to junk by Fitch and Moody's, as one goes even deeper, Fitch downgraded the bank's long-term issuer default rating to BB+. That's one level below investment grade from BBB-. And Moody's, which cut the bank to junk last month because they kind of knew something was coming, lowered its issuer rating to B3 from BA2. And what this means is going to be even harder for the bank to lend because Moody believes that New York Community Bank may have to further increase its provisions for credit losses over the next 2 years because of credit risk on its office loans. It also pointed to substantial repricing risk on multifamily loans. Now, what's important to understand here is when banks have to put more money into its reserves or credit losses, this is an issue because it means they have less money to lend. Now, in a slowing economy, this is a big problem because right now lending standards are already fairly tight. Now, for a New York Community Bank, that means they're about to get even tighter because they need to set money aside for these losses. They can't go and lend against it because they need to keep it in reserves. And the commercial banking system here is absolutely critical because we need them to originate new loans to create new money in the economy to continue the growth trajectory and to pay on all the debt. The challenge right now is that's in contraction, and New York Community Bank, their situation isn't going to help at all. In fact, here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. That's shown in blue and on net tightening anytime the blue line is over that horizontal black line. And what I want you to see is this is against commercial industrial lending. This is the weekly data shown on a year-over-year rate of change. That in red, that as banks tighten standards, well, eventually you see a deceleration in loans, and next thing you know, it goes into contraction. You see that happening here again during the global financial crisis, that the slowdown entered contraction. Now, the danger of a contraction here is that means banks are not seeing enough new loans being originated to cover all loans that are being paid down or paid off. That's an issue because just as commercial banks create money, at the same time they destroy money, and that is what helps. You'll notice here, send us into a recession or even worse, financial crisis, because these periods are shaded by these gray bars, which indicate recessions, and right now we are in contraction with commercial industrial lending, and New York Community Bank is not going to be helping with that much at all. But one thing that could be a big help is how you can make more money on your trading account. We make trading fun and easy. If you'd like to see returns like this, here 18.4%. This is a trade we gave you on the S&P 500. Let me show you just how easy it is, because every day we have two reports that go out. One on machine positioning that does something no one else does. That's a historical overlay. Second, we do a one on technical analysis, but we add an extra element to make the signal so smooth. But on top of that, we give you the signal straight out, and then we give you a video on how to trade them, stop loss levels, indication, my opinion on it. And this week alone, I put out 12 signals on our reports with videos. Check it out. There's one this Saturday, and I threw out some coupon codes for a free month. So even if you'd been a subscriber in the past and weren't sure if this was right for you, throw in a new email address, get a free month, and you could be making money just like our subscribers. It's so easy. Get 12 signals we put out. Many of them are already up. The rest of them looking to move. Here is a snapshot of our CTA Timer Pro showing the machine positioning. And then, of course, we've also got our Momentum Timer Pro report as well. Again, we make this so super easy for you. You can make money trading. Again, links in the description below, because now Germany is preparing a $6 billion tax package as things for this once great nation are now getting substantially worse. And we noted that this was likely to happen because their manufacturing base was slowing down. And many people said, look, this isn't an issue. It's okay. The services sector is going to drive our economy. But now they're having to do the unthinkable, which is stimulus. And why is this a big problem? Is because what do we keep hearing from the central elites around the world? That inflation is the issue. Well, inflation in Germany is about to be one of the last of their problems. Its overall value is likely to be in the region of about $7 billion, this according to one insider, although they stress the discussions are still in the early stage, which equate to about 0.16% of German output this year. Some economists believe that Germany needs about as much as $30 billion of stimulus, which would be completely unheard of, given, of course, the rates of inflation we're seeing, suggesting that things in Germany here are far worse than many people want to admit. In fact, while other major economies are enjoying relatively robust expansion, I like that relative to how poor the rest of them are doing, Germany is being held back by challenges ranging from high energy costs, exposure to the struggling Chinese market, and geopolitical tensions triggered by Russia's war on Ukraine. Notably, no mention of a slowing global economy. But let's take a look here at Germany and why what this really means here is this is going to come to America. I'm making the case here that what we're seeing in Germany and we're seeing also in China are going to affect every other major country in the world. Let's first take a look at the recent S&P Global Manufacturing PMI. As we see, manufacturing sector suffers a setback in February. This is not good because now we see it drop to 42.5. Now keep in mind, a print of 50 means it's unchanged from the prior month. So if you have a number below 50, well, the lower it is below 50, the deeper the contraction over the prior month. And remember what we saw is things were kind of moving upwards. The contraction was slowing. Everyone was getting optimistic that maybe the bottom was in. We said, look, it's highly unlikely that's the case. Sure enough, we're getting validation now as the manufacturing PMI drops to a 4-month low. And here you can see it had rates of decline in manufacturing output and new orders quickened in Germany, making a fresh setback for the country's industrial sector midway through the opening quarter of the year. This is dangerous. Look at this, weak demand conditions. Again, this was a case that we've been making the whole time, is this was a demand issue. And sure enough, we see that now in Germany has led to a sustained decline in backlogs of work across the manufacturing sector. The rate of depletion was the sharpest, so that's the biggest in 3 months, and quicker than the average recorded over the last 21-month sequence of declines. So what that tells us is that while everyone believes the global economy is kind of bottomed out and finally making this move off this soft landing that everyone's been hoping for, Germany is now setting the lead here and plunging even deeper. This is a dangerous sign because, well, it means the labor market's about to go. And here you can see expectations toward future output, meanwhile, turn negative for the first time since last November. So we look at these sentiment indicators and everyone was rosy, saying, look, everything's going to get better. And we said, you know, is this really a case where maybe things are so bad that they could only get better? And that's what they were reporting, not that they actually had a bunch of new orders. Well, it turns out they didn't have all those new orders. As we see sentiment deteriorate now for a second successive month, falling backlogs, economic uncertainty, and a lack of investment were among factors weighing on confidence, according to the evidence. With firms reporting a lack of pressure on business capacity and pessimism toward the outlook, there was a further round of, here we go, factory job losses in February. Furthermore, employment fell to the greatest extent since August 2020. This is someone who said exactly what would happen. When you chew away at your backlogs and you run out of new orders, you have to put people on the unemployment line. Now, the notion that you're going to get a big push out of the services sector, which generally is made up of lower wage jobs, is ridiculous, because as these people from the manufacturing sector go on unemployment, their incomes are going to drop. That means their spending has to go down. And with a lag, there goes, of course, the services sector. And along with that, of course, is going to be even more job losses. Here we see German job losses now increased more than expected this month. So, of course, we're making the case of why Germany has no choice to do some stimulus. But is $7 billion enough? Well, the experts say no. As joblessness in Germany rose by 11,000 in February, more than double the predicted 5,000. The unemployment rate held at 5.9%, the highest level in 2 years, as the labor market's resilience has been one of the few pluses for Europe's biggest economy, which might be in a winter recession. And we made the case this was only now the beginning of where this is going, because as demand continues to fall, which will happen as more people hit the unemployment line, well, you're going to see further decreases in demand from the factory sector. Let's look at some U.S. data here as validation. We have the manufacturers' new orders of durable goods shown in blue, that on a year-over-year rate of change, and we're going to use the unemployment rate. Now, we don't often use that on this show, but since these pieces from Bloomberg are discussing that, you can see that as demand for new orders goes down, with a bit of a lag, because there is an initial shock to the economy, the unemployment rate stays relatively flat and then it starts to turn up, just like we're going to start seeing here in Germany. And right now, what do we hear in the U.S. economy? It's being heralded as fantastic and it's great, and the labor market is strong because the unemployment rate is low. Well, it's low, but for how much longer is the question, because another issue here, as we've talked about from the central elites, is inflation. And what do we see out of Germany? It slows further, backing the ECB's rate cut plan. So you think about the unthinkable here, and it's really putting stimulus out during a period of high inflation. The reality is inflation indeed is coming down. Don't tell this to the central elites. They're not convinced. Consumer prices rose 2.7% from a year ago, down from 3.1% in January. That's right in line with expectations, looking very similar to the U.S. Consumer Price Index as inflation heads down to, of course, this 2% global target that central bankers have. But we know that as unemployment rate goes up, here shown in red, against the Consumer Price Index, this, of course, U.S. data, that's shown in blue on a year-over-year rate of change, what you see is more and more people fall out of the labor market. Well, demand comes down because they have less money. And when you have less money in a high interest rate environment where your debt service costs are elevated and you still have transitory high pricing to deal with, well, that means your discretionary spending has to go down. And sure enough, that's exactly what we see here. As the unemployment rate goes up, what do you know? Consumer price goes down. Right now, the consumer price index is falling, even though the unemployment rate stays low. Of course, we noted that continuing claims now are hovering just under 2 million, not showing any signs of a strong return to the U.S. labor market. In fact, if anything, the longer people stay on unemployment, that means more likely other people are going to end up on there until, of course, the Fed makes the biggest change in the vol, and that's the slam rates right back to zero. And speculation about a speedier move has cooled recently as policymakers voice alarm over elevated wage pressures. Here again, they can't see the fact that the factory sector is in this contraction and it's getting worse. They can't see that inflation is coming down, but yet they're so fixated that it has to do something with the labor markets holding up. That maybe if people get wage increases, somehow that will translate into higher consumer prices. But that's their worry, because should firms pass the higher costs on to consumers, how the situation will pan out is hard to predict. No, it's not hard to predict, because in a state of decline in demand, higher prices will lead to less demand. It's not a case where if someone says, I don't want to buy that now, and they raise the price, well, I guess I'll run out and go get it now. No, they say, well, you know what? That made my decision not to buy even easier. This is really simple to understand, and why a majority of the ECB wants to see evidence that pay gains are abating. Well, guess what, ECB? You're going to see it, because here you have the unemployment rate, again, back to the U.S. data, against total compensation, because they don't look at hours worked, they just look at hours earnings. Here we have average hourly earnings multiplied by average weekly hours. This is of production and non-supervisory employees for the U.S., shown in blue on a year-over-year rate of change. And sure enough, what happens, the first step is when production and demand goes down, you cut hours. And even if you're giving out pay raises, what happens is as you cut hours, more people get on the unemployment line. You see that relationship here go over year and time again. And what are we seeing now in the U.S.? A big drop in total compensation. We haven't seen an uptick in the unemployment rate, but that is likely to come in the near future. Germany here, again, leading the way, but just to provide you further evidence of how clueless these central elites are, let's take a look at what they had to say. Bundestate President Joachim Nagel is among those who've cautioned against loosening policy too soon, saying the price outlook isn't clear enough and that the detailed picture may only emerge in the course of the second quarter. And of course, by then, Germany is going to be in a depression. In fact, his Slovenian counterpart said that barring major surprises, of course, Germany's factory sector plunging into a depression would be a surprise to them. Rates will indeed be lowered, though he cautioned that the timing hinges on inflation, which is about to go away in a big way, and that excessive wage gains could delay the process. There's no evidence of that at all. And now let's take a look at the U.S. and why this is coming here, because we got a varying picture now on what's going on in the U.S. manufacturing sector. But I want you to frame this as what's happening in Germany. Manufacturing sector goes down, inflation starts coming down, and next thing you know, unemployment rate starts to go up. And here you can see our future is already baked in the cake. And here from S&P Global, manufacturing conditions in the U.S. improve at the fastest pace since July 2022. As we see, something has changed here in a big way. Contributing to the upturn was a renewed rise in output during February as production levels increased at the fastest pace since May of 2022 as previous supply chain delays, which hampered activity in January, eased. And while demand conditions strengthened. In fact, the rate of growth was solid and quicker than the trend pace. Panelists even highlighted more favorable demand conditions as total new orders grew at the strongest pace that was the fastest for 21 months. And alongside greater interest from customers, manufacturers noted that some clients had worked through safety stocks and were looking to replenish inventories, suggesting that all of a sudden, something here in the U.S. changed in a big way. Well, at least this is according to S&P Global. As increased new order inflows also spurred a sharper uptick in workforce numbers as manufacturers registered the quickest rate of job creation since last September. Now, what's notable is this doesn't match what we see in the weekly unemployment data. It doesn't match it at all because what did we see? An uptick in claims. Even though the initial claims remain low, the continued claims say high. So why aren't these people on unemployment getting back to work if the S&P Global is saying that everyone's hiring? And with many noting that the hiring of full-time and permanent staff was even up. And moreover, goods producers remain upbeat regarding the outlook for output over the next year, despite the degree of confidence slipping slightly. In fact, backlogs at work were broadly unchanged, suggesting that there's so many new orders now, they can't keep pace with them. And although capacity was expanded, greater new orders placed some strain on firms, suggesting that indeed the U.S. here is now in the beginning of that early stage of coming out of that soft landing. But hold tight, because the ISM, the Institute of Supply Management, says S&P Global's got this all wrong. And here we can see manufacturing PMI down in contraction at 47.8, suggesting something is much different here. And let's take a look at the ISM. What do we see in the manufacturing PMI? Further contraction over January now at 47.8 from 49.1. How about new orders? S&P Global says strongest in months. Well, ISM says, nope, we saw a contraction here. Production, contraction, employment, contraction, further contraction, even in the backlog of orders continues to contract, suggesting we have some sort of difference here between the S&P Global and the ISM data here. But what we do know is as banks like New York Community Bank continue to come under stress, originate fewer loans, that means demand goes down because there isn't enough money in the economy to satiate demand and play on all of the existing debt. On top of that, we see demand in Germany going down. That means, of course, as we see one manufacturing base go down in a globally synchronized economy, you'll see another one and another one and another one. According now, the only question is S&P Global right? Are we seeing the beginning of soft landing? Or is the ISM right? And we're about to follow the path of Germany down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.